Okay, some sample problems this week relating to Chapter 3. And these are from, again, the end of the text, the end of Chapter 3. And the first one we're looking at here deals with adjusting entries, and then I believe we look at one for closing entries, and then one with regards to financial statements. So the first one here, exercise 3.1, we've got preparing adjusting entries. Says to prepare adjusting journal entries for the year ended, date December 31st, for each of the separate situations. Entries can draw from the following partial chart of accounts: cash, AR, supplies, blah, 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 blah. We go down through the list. So we have 6 transactions here. So we'll do these by letter since we don't have a date. So transaction A is depreciation on the company's equipment for the year is computed to be $18,000. Well, again, if you've read the text or heard me in class, when we talk about depreciation, we're basically looking at this is how much we've used this asset, because we know as we put assets through wear and tear and use that the value of them is going to decrease. So basically, when we talk about depreciation expense, we're talking about how much we've used an asset. So here we'll have depreciation expense for, what is this, equipment. And they tell us over here we have depreciation expense for equipment, and that is $18,000. So we're going to debit 18,000 because it is an expense, and then our credit will be to accumulated depreciation. And accumulated depreciation, is what we call a contra asset account, meaning essentially that this affects this affects our asset in an opposite manner. So we're going to have a credit here for the same amount. But what happens is with accumulated depreciation, then this builds up, and essentially what we have is when we purchase an asset, we have what's called the historical cost, which is what we actually pay for it. And then we have our accumulated depreciation, and what we do is we subtract accumulated depreciation from historical cost, and that gives us what we call book value. So basically, we're tracking, this is a temporary account, depreciation expense. Accumulated depreciation, however, is a permanent account. Where am I at here? Let's get a little indent on here. Where'd we go? There. Okay, B. B is the prepaid insurance account had a $6,000 debit balance at December 31st before adjusting for the cost of any expired coverage. An analysis of the company's insurance policy shows that $1,100 of unexpired insurance coverage remains. Okay, so how do we think about this? Well, we'll do a quick little T account here. And in this T account, we're going to look at our prepaid insurance. Now, it tells us prepaid insurance, again, is an asset. We own the rights to this insurance. We had a $6,000 debit balance. So here's $6,000 on the debit balance, and this is just, like I said, a T account. And it tells us at the end of the year we have $1,100 left. So basically what they're saying is at the end of the year we have, this is our balance. So how do we get from 6,000 on the debit to 1,100 on the debit? Well, we have to credit 4,900. So here in B, what we have is we paid this insurance up front, but as time's gone by, we've used it. So essentially we have an insurance expense for what we've used for the, what was it, 4,900. And then we credit our prepaid because now that we've used part of this insurance, we no longer own that much of the insurance. So that's B. C, we have supplies account had a $700 debit balance at the beginning of the year, and $3,480 of supplies were purchased during the year. The December 31st physical count showed $300 of supplies available. They cheat here. We've got cheaters because they say you should debit supplies expense for an amount. But let's look at how this works. So we'll pretend this is the supplies account down here in our little T account. We'll get rid of these numbers. So it says the supplies account had a $700 debit balance. There's $700 debit balance at the beginning of the year, and $3,480 of supplies were purchased. Well, supplies is an asset, so if we're purchasing it, we're increasing it, and increase on an asset is on the debit, so we would have 3,480 here debited. And the December count shows 3,000 or 300 available, so we have an ending total of 300. So we have to know that, or we have to think, these two debits totaled. We have to have a credit amount that if we subtract from them, we will get $300 left. So these two debits total $4,180. So if we take $4,180 and subtract 300, we will find we get $3,880. And of course, they cheat for us and tell us to debit that here. But anyways, we're going to debit supplies expense for the $3,880. And then we will credit our supplies because now we don't have that much in supplies, and supplies being an asset, if it decreases again, we have to credit that. So supplies will be credited $3,880. Now we have D. And for D, it says 2/3 of the work related to $15,000 of cash received in advance was performed this week. So what it's saying, 2/3 of the work related to $15,000 of cash received in advance was performed this period. So what they're saying is we received $15,000 ahead of time for work we didn't do, but we've completed 2/3 of that work. So if we were to multiply 15,000 by 2/3, we'd see that now we need to record revenue of $10,000. And because unearned revenue is a liability and we have completed that liability, and a liability has a normal balance on a credit, we're going to decrease it by debiting. So we have a debit to unearned revenue of $10,000, and now that we've earned this, now we've performed the work to earn it, now we can claim the revenue and credit our revenue for the $10,000. All right, now number E. Prepaid rent account had a $6,800 debit balance at December 31st before adjusting for the cost of expired prepaid rent. An analysis on rental agreement showed that $5,800 of prepaid rent had expired. Again, they cheat here, but that's okay because we're still going to calculate it. So prepaid rent had a $6,800 debit balance. Okay. Before adjusting for the cost of expired prepaid rent. An analysis of the rental agreement shows that $5,800 of prepaid rent had expired. So basically, we're looking at $6,800 on the debit. If we've used $5,800, that would be on the credit. So if we look at this, we have what, $1,000 left in prepaid rent. So for E, we will have a rent expense, and this is for, what was that amount again? $5,800 is our rent expense because it says $5,800 of prepaid rent had expired. So that's telling us this is what we've used. I don't know why I did that T account. I'm hoping we have to come back to that, but maybe not. Prepaid rent, we're going to be crediting here because, again, if we've used it and we already paid for it, we can't state that we still have that amount available. And the last one, F, we have wages expense. And for this, wage expenses of $3,200 have been incurred but are not paid as of December 31st, which means essentially we have these wages we owe, but the pay period doesn't come until after this period ends. So the $3,200 we owe for that, so that we know that's going to be a liability. It's going to be credit to wages payable. The thing is, in this period, we use the workers, their labor, their intelligence, their efforts, everything that they do to provide the goods or services that our company makes. So in this case, we're looking at a wage expense here for the $3,200. And then our credit will be on wages payable because we will pay this in the next period. All right, now, was there a part 2 to this, or is this the only thing we had to do? Let's see. This was it for 3.1. So these are adjusting entries. Okay, these are how we make these in a sense. Now, if we go to 310, the next problem I wanted to look at here, and with 310, we're looking at closing entries and how we look at closing entries here. So I've got over here some T accounts, and they go off screen, and I really don't want to make this any smaller than it already is, so we'll shuffle that one when we need them. But anyways, we have an adjusted trial balance here containing the accounts, year-end balances, cruise company as of December 31st. Prepare the December 31st closing entries for cruise. Assume the account number for income summary is 901. Prepare the December 31st post, and then we have to prepare the post-closing trial balance. Retained earnings account balance was $37,600 on December 31st of the prior year. Okay. So when we look into closing, basically what we're doing is we're going to take the temporary accounts, and our temporary accounts, when we talk about them, we're talking about revenues, we're talking about expenses, and then we also talk about income summary as a temporary account, which is the account that we're going to use here for our revenues and our expenses. And then also we look at dividends as a temporary account. So these are the accounts that we'll be specifically looking at to close. And we close because the revenues from one period to the next, we can't bring revenue from one period into a next period. When the period ends, we have to report the revenue for that period. And it would be illegal, immoral, and unethical for us to report revenue from a prior period in a current period. So we have to close it all out so these revenues and expenses, these temporary accounts, are back to zero. So our dates here, it tells us December 31st. We're going to have that date everywhere. And the first thing we'll close, the easiest, is probably usually revenue. All right. So if we look down through here, we have services revenue, $44,000 on the credit. So if we want to think, if we have $44,000 on the credit, well, how do we close that? We close that by debiting that account. That essentially, we're looking at, we want to have a zero balance. So we're going to debit the services revenues for $44,000, and then we're going to credit this temporary account that we call income summary. And we're only going to use this income summary for closing. So as we go through, I hope you'll see what we're talking about here. Okay. Now, again, we're going to be on December 30th, and those are all the revenues we have. We just had our service revenues. And then again, 12/31st. Now we're going to do expenses. Now, if we look at expenses, our expenses are on the debit. So we want to credit them. So if we're crediting expenses, then we'll have to be debiting our income summary. That will be our debit here. All right. So we don't know what that's going to be yet. We're going to put our expenses here. So the first one we have our, we look over on our trial balance, depreciation expense for equipment. And that is 3,000. And then we have salaries expense for 22,000. And again, remember, these are all debited. So to zero the account, we're crediting these. We have insurance expense. That is 2,500. Rent expense for 3,400. And then supplies expense. Oops. For 2,200. All right, now, if we total these, let's see. Where are we at here? All right, we'll total those and we get 33,100 on the debit. So all of these credits add up to 33,100. Okay. Now, we want to look at this, and now we're going to look at income summary. So let's see, do I have, let me indent these first. All right. So if we think about this, our income summary, if we do a, I'm going to scroll down here and draw a little T account real quick. Underline this. I know I have some to the right, but I've got those for the next part of the problem. So let's do a little T account here real quick. right border, and this will be income summary. Okay. So if we look at this, we have a credit for 44,000 in income summary, and we have a debit for 33,100. So if we look at this and we say, okay, well, what would our balance in income summary be? It would be to the credit side. If we take the difference here, subtract the smaller from the larger, and then the balance goes on the larger side, 10,900. Okay, so we have a credit balance in income summary right now, and we'll just for posterity here. We have a $10,900 credit balance in income summary. So to clear that, we have to debit income summary. And we're debiting the 10,900, and we close income summary to retained earnings, our little, if you will, piggy bank for our company. Now, if we think about this, retained earnings is part of equity. Retained earnings is also an increase to it is on the credit, which means basically it's a form of. If we think about this, this is like revenue. We've gained money here. So basically, we have essentially net income here of $10,900 for the time being. So we've closed income summary to retained earnings. Now we have to close dividends to retained earnings as well. Now dividends is on a debit, so we know we're going to credit it. Oops, D-O-D-I-D, yes. For was a 7,000. And dividends gets closed to retained earnings. And this should make sense because if we're paying dividends to shareholders, that's got to come out of someplace, and it comes out of what we've already had in our retained earnings account. So these are the closing entries, and when we're done with closing entries, the only thing that really should have a balance essentially is our retained earnings. Everything else will be zeroed out. And now we're going to look at, let's see, we want to prepare the December 31st post-closing trial balance. Now, when we talk about a post-closing trial balance, this should only have balances for permanent accounts on it. So our dividends, our revenues, our expenses, that's all going to be gone. And this will be a much shortened type of trial balance. And I have the T accounts over here so that we can determine what our balances are and how these things work. And I have retained earnings here because this is not a temporary account. The rest of these are. So if we look at our transactions, and I've got the balances here that are our what am I trying to say? The balances from the trial, the adjusted trial balance. That's what I keep wanting to say post closing, but this is adjusted. I've got the balances from this trial balance here. So if we look from what we've journalized here and put these types of things in where we're closing, then we'll see what happens. So on the trial balance, remember services revenue had a credit of 44,000, so we're debiting because here's our debit, which leaves us a balance on services revenue 0. Okay. Income summary, we credit 44,000 in that transaction, so we'll do that here as well. And we just need to go down the line. Income summary, debit 33,100. Depreciation expense for equipment, credit for 3,000. Salaries expense, credit for 22,000. And if we look, we have insurance expense, we're going to credit for 2,500. Rent expense for 34. Supplies expense for 22. Let's see, what else do we have? Then we have income summary here for 10,900. Retained earnings for 10,900 on the credit. And then we have dividends, 7,000 of retained earnings on the debit, and 7,000 of dividends on the credit. So if we look at this situation and we look at dividends, well, dividends, they cancel out, so we have a 0 balance for dividends. Our revenue cancels out, 0 balance there. Depreciation expense cancels out, 0 balance there. Rent expense, zero balance. Insurance expense, debits and credits are even, so zero balance. Salaries expense, zero balance. Supplies expense, zero balance. Now income summary, yep, zero balance. So everything zeroes out except for retained earnings. And now we have to look at this and get a balance here. Yeah, it's fine. In our retained earnings. So we have essentially 37.6 plus 10.9 minus 7. So what do we have here? We have, is it 40? Oh, let's see. That would be 48.5 minus 7, 41.5. So we'll have 41.5 over here on retained earnings. So now, if we go back to here a little bit to our post-closing trial balance, okay, retained earnings is the only account in our T accounts over here we have to worry about the balance of. Everything else we can take from this. So we have cash. We know that's 19,000. We have supplies. What is it? 13,000. Prepaid insurance is 3,000. Equipment, another asset. Debit balance of 24,000. Then we have accumulated depreciation on equipment. That is 7,500. We have common stock. Common stock is 10,000. And then we have retained earnings. And remember, retained earnings we had to adjust because of our net income and dividends. So retained earnings, if you remember, if we scooch over here, we had a $41,500 credit balance. So we'll come back over here and put 41.5 on the credit side. And now this everything else, if you look on our trial, it's everything below retained earnings, dividends, revenues, and expenses is zeroed out. So we don't include them on the post-closing trial balance. So if we look at this, we'll sum up our sides and hopefully we come out even here. 59,000 on that side. 59,000 on that side, we're good. So this is our post-closing trial balance. And we balance out, and this is how we close. Now, the last problem I want to look at is preparing the financial statements. Now we have the adjusted year-end trial balance here. And what we need to do is prepare the income statement, statement of return, and statement of retained earnings. And it tells us the retained earnings account balance was $155,000 at the prior year, at the end of the prior year. So we're going to do the income statement first. And remember, income statement basically is just revenues and expenses. So if we look down and find our revenues first, that's what we want to find. Let's see. Trucking fees earned is our revenues. So we have trucking fees earned. And this is 130,000. So 130. All right, and that's the only revenue account we had. So since we have multiple expenses, I'm going to list them down here. And in our expenses, we have depreciation expense for trucks. Depreciation expense, trucks. We have salaries expense. Oops. We have office supplies expense. We have repairs expense. Repairs expense. Trucks. Okay. And then we'll have total expenses, of course. And then we'll have net income. All right. So our expenses, we'll indent these to make it nice and pretty. Okay. So our expenses, depreciation expense for the truck was, where did it go? 23.5. Salaries expense was $61,000. Office supplies expense was $8,000. Oops. And repairs expense for trucks was $12,000. So if we total these this would be total expenses if we total these, and we'll put a total over here. And the total of our expenses $104,500. We will bottom border there. And then we have our net income. So basically, we're looking at revenues, which is this, minus expenses. So we have net income of $25,500. And we'll double underline this because we should. This tells us this is our end result. 25,500 is our net income. Okay, so there's our income statement. So now we need to look at statement of retained earnings, and it tells us that the prior year we had $155,000 in retained earnings, and we always start with what we had, what we began with, retained earnings, December 31st, I guess it's prior year, we'll just put prior, and that amount, again, was $155,000. Okay, so we have to add the net income, and we have net income of $25,500, so we're going to put net income here, which is $25,500, and we'll do a summation of that. So we have $180,500 essentially in retained earnings before we take out dividends. And that's what we're going to do next. We're going to deduct dividends. And dividends were $20,000. So we'll put this in parentheses. Actually, that'll change it to a negative, but we really should have this listed as in parentheses. We don't need any decimal places, but we do want a negative number in parentheses here. Okay. So then we look at, this is our ending retained earnings. And that was prior. We'll say this is current. So again, we'll put a total line here. And our retained earnings at the end of this period is just our beginning retained earnings plus net income minus dividends. So we're looking at $160,500 for retained earnings. Okay. So this, the closing is probably a big one. There seem to be trouble sometimes with closing, and then in adjusting entries, thinking about those. So if you have any questions or anything, you're welcome to call, text, or email. Other than that, I will have something else for you probably early next week or so. Again, questions, concerns, anything, reach out to me. Other than that, have a good weekend.